Hi everybody, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this stock market update and industry sector review for the week ending Friday, February 16th, 2018. Before we get into the stock market charts and the industries, let's take a look at the quote of the week. This week's quote is from Charles A. Beard. If you don't know who Charles Beard was, well, Charles Austin Beard was one of the most influential American historians of the first half of the 20th century. For a while, he was a history professor at Columbia University. He was born 1874 and died 1948. Charles Beard once said, "When it is dark enough, you can see the stars." Very wise words from Charles Beard. I also have a slight variation on that I heard from my pastor, Carl Sutter, last year. I'm going to paraphrase Carl. He said, "When things look their darkest, remember that winter does not last forever." Very wise words from Charles Beard and Carl Sutter. All right, let's take a look at the charts, starting with the Dow Jones Industrial Average. It has been a very volatile 2 weeks for the stock market. Not sure if we are facing dark times ahead, but whether it's dark times or sunshine, all we can do is look at the trends, see what the charts are telling us, and prepare accordingly. So let's jump into the Dow Jones Industrial Average. Here we have the 6-month chart of the Dow Jones Industrial Average. As you can see, we had a very nice trend for much of the second half of 2017. We finished 2017 and early 2018 with a parabolic rise, accelerating faster and faster to the upside. And as I had mentioned about 3 weeks ago, parabolic rises usually end with pretty severe downside corrections. And sure enough, that's exactly what we got here. We ended up at the top on January 26th, and then the Dow lost about 10% in about 2 weeks, bottoming out here on February 8th. And since then, we've had a bounce or a slight recovery. Not sure if it's a bounce or a recovery yet, because the 5-day moving average in red is still below the blue 20-day moving average, which means we have short-term weakness. We do not have a confirmation of short-term strength yet. And that blue line, the 20-day moving average, is getting pretty close to the 50, but starting to move a little parallel there. But that indecision there just means that we have a lot of indecision on the intermediate term. So lots of mixed signals for the Dow Jones Industrial Average. We need about another week or so to gain some more clarity as to where this market is going. Here is the 6-month chart of the S&P 500, much the same as the Dow Jones. Nice parabolic rise into January 26th, and then a rapid 2-week sell-off, losing about 10% in 2 weeks, bottoming out there, and we've had either a bounce or a recovery, but the jury is still out. The red 5-day is still below the 20, indicating short-term weakness, and that blue 20 is still close, but now parallel to the 50-day, indicating lots of intermediate-term indecision. So no clarity as to whether we're bullish or bearish yet on the Dow or S&P, just a lot of mixed signals and a need to be using caution. Here is the 6-month chart of the Nasdaq 100 index, and much the same. We had a top on January 26th, 2-week sell-off ending on the 8th of February, and then a very rapid rise out of that bottom here, ending on the 15th of February, where this is being recorded. And we currently have a little more strength than the Dow or S&P, because that 5-day average in red is about a day away from crossing back above that blue 20-day moving average. So we'll know in the next few days whether the Nasdaq 100 is turning strong again. Right now, it's still to be determined, but the Nasdaq 100 is definitely looking more, looking better than the Dow and the S&P. Here is the 6-month chart of the S&P 500 Materials Stock Index. These are chemical companies and industrial companies and materials companies. Companies that manufacture materials for industrial production, or they dig stuff out of the earth. We had a peak on the 26th of January, rapid sell-off, and we're trying to dig our way out of the basement here. We have a very interesting convergence here as of the 15th of February. We've got basically the price of the basic materials index sitting right on the 5 and the 20, which is the blue and the purple. So the next week is going to tell a lot about materials, and we still have short-term weakness though with that red line well below the blue, which is the 5 and the 20. So still a lot of mixed signals on materials, but definitely come a long way in the last few days since February 8th. We've recovered about a third of the way back to the high. We shall see where we go. Here is the 6-month chart of the S&P 500 Information Technology Index. I think this might be the strongest chart of the bunch, but we had a peak here on the 26th, the 2-week sell-off, and then we've made it more than halfway back to the top up here. And as of right now, we're only a day or two away from that red 5-day moving average crossing back above the 20. So if that in fact does happen, that means that we've got short-term strength for technology stocks, and the blue 20-day moving average may start to pull away more from the purple 50-day, and if that happens, then we'll have increasing strength on the intermediate term as well. So right now, based on the charts that we've looked at, technology is looking the strongest of the bunch. Let's move on to the consumer staples. Here we have the 6-month chart of the S&P 500 Consumer Staples Index, and it got beat up pretty good. We had a nice peak here on January 26th, and then it dropped all the way down to there on February 8th. That was a pretty significant drop. That was about 10%, and it's still struggling. The price on the 15th of February is right here at the end of this black line. So we're still below the 20 and the 50-day moving averages, but the 5-day average here put in a bottom and the price put in a bottom. We'll just have to wait for the next week to see if consumer staples can claw its way back up at all. But right now we've got a lot of short-term weakness and intermediate-term weakness. So I just say probably use significant caution regarding the consumer staples stock index at this time. Here we have the 6-month chart of the S&P 500 Industrials Stock Index. It's made it about halfway back. We had that high on the 26th, 2-week sell-off on the 8th, and then boom, we bounced up again, and the black price of the index is back above the 5, the 20, and the 50. So that's a good start. But we still have short-term weakness with that 5-day average in red below the blue 20-day average. And the 20 and the 50, the blue and the purple, are still kind of going sideways. So we have a lot of short, intermediate-term indecision. So as of right now, we still have a lot of caution that should be taken regarding the S&P 500 Industrials. We'll see what the next week brings us. Here is the 6-month chart of that S&P 500 Utilities Stock Index, and for any of you who have watched the last few videos, this was pretty much our ugly duckling. It has not gotten any sort of a break at all since November 14th. Really, ever since then, it's just been down, 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 just taking a beating. It's kind of sad, really, because utilities are a pretty reliable industry. You know, we need water and power and stuff to keep our lives running. But from an investment standpoint, it's been pretty punishing to just watch this thing go down for two and a half months or so. We bottomed out on February 8th. Small little bounce here. So we've clawed our way out of the basement. Not sure if this is a sign of strength yet. The 5-day average in red is still below the blue 20-day average, so we're still facing some short-term weakness, and that blue 20-day average is still below the purple 50, so we have intermediate term weakness as well. So as of this video, caution still should be warranted on the utilities stock index. It's still struggling to get ahead in any way whatsoever. Here is the 6-month chart of the S&P 500 Consumer Discretionary Stock Index, and again, if you have seen any of the prior videos, this was our all-star. It was accelerating faster and faster in a parabolic fashion and almost getting to the point of going vertical as of about January 23rd, or at the peak January 26th. And as I had said in those previous videos, parabolic moves often result in very rapid corrections, and as of the 26th, boom, something changed and we dropped pretty hard, about 10%, almost 10% from the 26th of January down to February 8th, and we bounced or beginning a recovery. Not sure yet which way we're going here on the bounce or recovery verdict, but that 5-day moving average in red is just about to cross that 20-day moving average in blue, and if it does, we'll have our short-term strength back again. And with that blue 20-day average still above the purple 50, we still have some intermediate term strength present in this index. It's kind of a mixed bag though, because the blue and the purple are kind of going sideways, so there's a lot of indecision still. So again, as with many of the other indexes, the next 7 days or so should tell us a lot. Here is the 6-month chart of the Dow Jones Financial Stock Index, and let's see, we have a peak here on the 26th of January, rapid 2-week sell-off bottoming out on the 8th of February. I'm sorry, did I say that? The first, January 26th was the top, February 8th was the bottom, and then a bounce or recovery in process here as of the 15th of February. That 5-day average in red is starting to get close to the 20-day average in blue and the 50-day average in purple. So again, the next several trading days will tell us a lot whether or not we are bouncing off the bottom or recovering and headed toward the top. Not sure yet. There's a lot of indecision here with the 5, 20, and 50-day moving averages. Here's the 6-month chart of the S&P 500 Energy Stock Index. We had a peak up here on January 22nd, just slightly different than the other ones, which topped on the 26th. We did have a little tiny peak there on the 26th before the stock market sell-off for a couple weeks. Bottomed out on February 9th, and a couple little up days here for the energy stocks. So we're trying to dig our way out of the basement here, and we have a long way to go. Right now, that 5-day moving average in red is well below the blue 20-day moving average, indicating a pretty substantial amount of short-term weakness. And the fact that that blue 20-day moving average has crossed below the 50-day moving average indicates we now have confirmed intermediate term weakness as well as of February 12th. So there's a lot of weakness and caution to be taken here in the energy index. Not sure if it's going to be able to recover at all. You can see that from the 25th of September right here all the way over until about November 29th, so 2 months, we traded sideways about the same exact level, and that's kind of where we're sitting right here on the 14th or 15th of February. So we'll see. We'll see if we can get some strength here and some stability, but right now it's pretty cautious for the energy stock index. Here is the 6-month chart of the healthcare stock index, and it got punished much like the energy stocks as well. We had this amazing rally that began on December 29th, shot up here like a rocket, began to go vertical, and again, I sound like a broken record, but parabolic moves that start to go vertical usually don't end very well. And sure enough, January 26th, we hit a peak, and then this thing just came unglued and just fell like a rock and bottomed out on February 8th. Now we've bounced a little bit here, and we're trying to recover some, but that red 5-day moving average is still well below the 20, indicating short-term weakness, and the 20 is in blue, the 20-day average in blue is really trying hard to cross below that 50-day moving average in purple, and if it does, that would indicate intermediate term weakness as well. So right now for the healthcare stock index, there's just a lot of caution that's needed. Be careful here. Not sure where we're going yet. We need another week or 2 or 3. We'll see where we go. Here's the final chart for the day. We have the Dow Jones Real Estate Index over the last 6 months. Lots of sideways action here, going for much of August, September, October, November of 2017. And then on excuse me, December 18th, we kind of hit a third top. We had one top here, another top there, and then a third top there, and that was it. Just boom, started to slide. And the real estate stocks bottomed out here most recently on February 8th. Not sure if that's the end of the slide yet, but we have been digging up out of the hole a little bit here, either a bounce or a recovery. The next week or 2 will tell a lot as to whether or not it's a bounce or a recovery. The price of the real estate index is above the 5-day average, but it's just barely starting to turn upward on that red line. So we'll see if we can get that red line, the 5-day average, to turn up and cross back above the blue 50 or 20-day average and give us some short-term strength. But right now, caution is needed in the real estate sector, and we'll just see where we go next week. Thanks again for watching this market update and industry sector review. I hope you found the charts and information useful and giving you a sense of the direction of both the U.S. stock market indexes and the different industry sectors. I ask you to please remain cautious and aware of what we are experiencing right now. This kind of volatility is pretty extreme. It's more than we've had in about 2 years. And I don't know if we're going higher or lower quite yet, but it's important to just pay attention because as the great Jesse Livermore once said, it is important, or I should say, it is better to be out of a market wishing you were in than being in a market wishing you were out. So just some food for thought there. Jesse Livermore was one of the greatest investors of all time. And before I go, I want to say please click the subscribe icon on the YouTube channel and then click the little bell next to it so that you are notified whenever I post additional videos like this. And then go to Facebook, LinkedIn, or Twitter if you use any of those 3. Look up Christensen Wealth Management and like or follow those social media sites, because I only make these videos about once a week unless something strange happens. And during the week, I can post stuff on social media right away and get that out to you. So it's important to use YouTube, Facebook, LinkedIn, and Twitter all together so that we can all communicate most effectively. All right, that's all I have. Have a great day, and I look forward to talking to you soon. Bye-bye.